Well, good afternoon, traders. My name is Don Prattle. I'm the Director of Trader Development and Education here at TradeStation. It gives me great pleasure to bring one of our very top educators in the industry to TradeStation this afternoon to discuss markets with us. Sam Seiden, the Chief Education Products and Services Officer at Online Trading Academy, will cover two very important components to trading. Figuring out where prices will turn and where they'll go is the main question that we might have in trading. Our session will focus on the two components that allow us to predict prices, our price turns and moves with a very high degree of accuracy. Now remember, everything we talk about here in these presentations are for educational purposes only. All the symbols and all the trading ideas that we discuss are for demonstration purposes. They're not recommendations. This presentation is not an offer or a solicitation of any kind any place where a TradeStation affiliate is not authorized to do business. Active trading is not suitable for everyone, and options trading itself carries a high degree of risk, may not be suitable for all traders. So in the chat panel above all the comments, I've posted a couple of disclosure PDFs that you may want to take a look at when you have time to help talk. It'll help introduce you to the characteristics and risks of standardized options and the other asset classes that we trade here at TradeStation. Now, the question has already been posed in the chat panel regarding the recording of this event, and the answer is yes. We are recording. We'll have this posted as soon as we have run it through our production processes here at TradeStation, and we'll put it in the TradeStation University segment of the website. We'll also post it to the video station on the TradeStation platform if you're a TradeStation user, and on the TradeStation YouTube page. Sam, I'm going to bring up your presentation that you just sent me, and that you want to start out with, right?
Sure.
All right, very good. So there you go. So Sam, thank you very much for coming in today. I know you had a big trading day, a very active day in the markets, and so I know your time is valuable. So please, I hope everybody that you offer Sam some great courtesy, and let's keep those comments. Use good etiquette in the chat panel. In other words, thanks for coming, Sam.
All right, great to be here. Great to be with everyone. So, yeah, most of you, we're together. I'm assuming everyone can hear okay and see the screen, and so we're together. Most of us are together Friday mornings for about 30 minutes before the market opens, the market, and we cover futures, forex. We talk a little options once in a while, but mainly levels and market timing and all that. Because it's only 30 minutes, there's never a chance to really dive into strategy and go into rules and stuff like that. So that's what we're here for today. Okay. Great. Looks like everyone can hear okay. Yeah, and feel free to keep the chat nice and active. Whatever any comments, questions, I'll try to get to them. If I miss one, I apologize in advance, but I'll keep an eye out for it. So yes, today will be very educational. It's a great day to have this. Obviously, big market moves today. I know some people that will be watching the recording will probably be watching the recording a year or two from now. So what happened in the markets today won't really matter then. But it is a big day in the markets, huge down day. And so we're going to go over how we handled that, the trading that took place on our end with that move and everything. Okay. So real market timing for income and wealth. Make sure you understand that everything we're going to talk about here today is equally applicable in any asset class: stocks, futures, forex, options, real estate, and then time frames. Whether you want to be a very short-term trader for income or all the way out to your most longest-term investor. The core strategy and rules that we're going to discuss today are equally applicable across all of those. Our focus again, is market timing, something a lot of people say can't be done and you shouldn't do. All right, so let's set that aside for a minute and move on. I want to give you a little bit of my history, not because I like to talk about myself, because I don't, but I think it'll help you understand the material as we go forward. And we're going to keep it really simple, and I'll tell you from the beginning, the biggest challenge that you will have in executing the strategy we're going to go over today is to keep it simple. If you can follow rules and keep things simple, another way to say that, if you can follow simple rules, you can do very well at this. But that's a big challenge for most people. I started my career on the floor of the Chicago Mercantile Exchange many years ago. I had no experience. It was just a summer job with my buddies many, many years ago. And I've been at this now over 20 years, always trading, sometimes, a lot of the times managing funds for people, and some of the time in the world of education like we are today. But back on the trading floor, again, I had no experience. And I didn't know what I wanted to do, career-wise with my life. I knew one thing for sure, though, that, I saw the way my grandfather lived, and he did very well in real estate. And to sum his life up, he lived the life that he chose to live. He did what he wanted to do when he wanted to do it, and it's because he had enough money to, money buys time and choices. Money doesn't make us happy. We all know that. It helps. But what money buys is time and choices. So when I was a teenager and very young 20s, I knew I wanted to create a life like that. And I had plenty of examples of people I knew and family members that were living lives that I didn't want to live. And so I didn't know how I was going to do that. Once I got a taste of what went on the trading floor, I was hooked. So my job was to facilitate institutional order flow at the time. And so I would take orders from banks, institutions, money managers, hedge funds, you name it. I started out on a big trade desk right outside of the trading pits, and I would facilitate those orders. So what I had in front of me all the time were just massive buy and sell orders. And every day I would just put those in the market. Now I couldn't trade my own account at the time. It was illegal because, again, I wouldn't be able to lose, right? I knew where banks were buying and selling because I had those orders. So it was illegal to trade my own account. However, if I wanted to know where price in just about any market down there was going to stop falling and turn higher, like the S&P, for example, I would look down and to my left and find the largest stack of buy orders below current price, and that was going to be the market's demand. I want to know where the Japanese yen was going to stop rallying and turn lower. I'd look down and to my left and find the largest stack of sell orders above current price. That's where the market was going to stop rallying and turn lower. So, how prices moved and how and why prices turned in markets, there was no question in my mind. It was all a function of just pure supply and demand, right? It's like a discussion around gravity. It is what it is. So you didn't have, online trading or anything back then like that, but you did have charts, and slowly but surely, you could get charts at home. The average person could. So I jumped all over that. But before I started doing this from home back then, I spent quite a bit of time training my eye to see those orders on a price chart. And that's at the heart of what we're going to cover today. And we'll get very focused in just a few minutes. But I want to make sure you understand what really hooked me into this business, because it's important to know this for yourselves. Every day I saw two major groups at play in the markets. There were banks and financial institutions, and there was your retail trader and investor. And what I clearly saw, because I handled all the orders, was that banks and institutions were right in their decision-making process most of the time, and as a whole tended to make a ton of money. Your average retail trader and investor was wrong in their decision-making process most of the time, and as a whole either lost money or never came close to achieving their financial goals. The gap in performance between these two groups was so wide, And what really hooked me into this business was realizing that, wow, this group is so good, this group is so bad, and they're both buying and selling in the same markets. Get that? Like, in other words, what was this group doing that this group wasn't? And that was like 20-something years ago. What's happened in the over that time, in the past 20-something years? Has the gap in performance between those two groups gotten more narrow, wider, stayed the same? What's happened since then? Right? Yeah. It either hasn't changed or gotten wider. So what I wanted to do is figure out what the smart money was doing. What were banks doing that that your average trader or investor wasn't? Okay. So let's move on. So as we get into price charts next, we're going to focus on making sure we can answer two questions today. And these are the two most important questions. And when you're on a trading floor, these are easy to answer. Okay, it's just very simple. And I'm assuming everybody can hear okay and see the screen all right. So the two questions, right? Where will price turn and where will price move to? So let's back up and answer those logically, right? On the first one, where's price going to turn? Price is always going to turn in any market at price levels where supply and demand is out of balance. The more out of balance supply and demand is, the more likely you are to get a nice big turn in price, right? So those are our supply and demand levels. Okay. Another way to say that is unfilled orders cause prices to turn. You'll see in a minute, yesterday after the Fed announcement, the equity index markets rallied up to a price level, a supply zone for us, okay? A price level where supply greatly exceeded demand according to our rules. I'll show it to you. It's the trade we took. And meaning there were many unfilled sell orders up there. And we'll look at a chart in a minute to see this. Next, where is price going to move to? So if unfilled orders cause prices to turn, filled orders facilitate price movement. If you have a price range where eventually most, if not all of those orders get filled, the next time price goes through that price range, it's going to have an easy time going through there. Does that make sense? Okay. Make sense? So let's dive into the price charts and take a look. So here's a recent trade, and anytime, just so you know, that you see a trade like this with a profit or loss on it, just understand that those are all real trades. Those are not hypothetical returns or demo accounts. So here's a trade I took, just a quick little day trade. But now take a look. I'm assuming you can see. Can you see the mouse, the pointer? Not. I can probably. Can you see the pointer? Okay. Hang on. I'll make that work. Ah, here it is. Let's get the drawing tool. Laser pointer. There we go. Can you see the red dot? Okay. We'll use this. Now it's my first time using this, so give me a little minute to get used to it. All right. So here was a supply zone. Okay. So how do we know that? How do we know that banks are selling here before? This is where we sold. This is where I sold short. This is my profit target for this trade. Just want to start with a real basic one for you. But how do we know that this is supplied? How do we know that banks are selling here? Well, prices are trading sideways. Supply and demand appears to be in balance, and all of a sudden, there's a drop in price. Understand that once prices decline as they do here, we understand that the only reason why that can happen is because supply exceeds demand right here, right? Right here is where the last buy order is filled, and you have a lot of supply left over, price is going to collapse. It's that competition to sell with a lack of buyers that forces prices down, correct? Now, so this is one of the patterns. There's two patterns that tell us where banks and financial institutions are selling the smart money. But there's a little more to it than that. In other words, it's not enough to just know where those levels are. We want to be able to quantify how much supply is actually there. Now, we're never going to get the exact number, but we can get close. I want to know that this isn't just any old supply-demand imbalance. I want to know that there's a significant imbalance here, that there's tons of sell orders. Make sense? Okay. Yeah, so Bill, so when I see this picture here, this reminds me of the trading floor, okay? And because I was in this position a lot. So I'm on the trade desk and I'm filling a big, I'm getting a big sell order filled for some big client. It's either a bank or some other institution or, some big fund. But the problem usually was the order was too big. In other words, what they're going to say is, sell me, 10,000 S&Ps at 27.20 right here, right? Okay. So we start selling them and selling them and selling, but pretty quickly we run out of buyers. So maybe we get half of them done. Maybe we get 500 done. Price collapses. Do you think that money manager or whoever's account that is going to call back and say, oh, that's okay, don't worry about it, just sell them at a lower price? You think that's going to happen? And I'm not just talking to you. No, they don't do that. The smart money doesn't budge. Okay? So those orders are sitting there. All right? And the quantity changes, maybe not from that specific person. Other people come into the market, in and out of the market, but we're talking about significant orders. Okay? We can see the footprints of the big money, and that's what we're working on here today. All right. Okay. Yeah. So absolutely, we're going to look, Marius, at a bunch of different charts. Okay. So how did price leave? So we've got the pattern. How did price leave the level? The next way, so the stronger the drop in, or the stronger the move in price away from the level, the more out of balance supply and demand is at the level. The next thing we can look at is how much time price spent at the level. I mean, would you say price spent a lot of time here or a little time? Price didn't spend much time here. So we call these odds enhancers. In other words, the less time price spends at a level, the more out of balance supply and demand is at the level. Now, here you have the potential for the most activity or volume, but you don't get it because all that competition, all that potential is on one side of the market, the sell side here. And I can go on, right? And we have a list of odds enhancers, things we can look at that help us quantify how out of balance supply and demand is. And none of it's rocket science. It's all just simple logic. Okay. But let's move on. Next, okay, price comes all the way down to here before returning up to here to the zone, which is where I sold short. We'll get to that in a minute. So even though we have a price point, so when price is down here, I already know that I have a supply zone up here where I'm fully expecting prices to stop rallying and turn lower. However, that's not enough. I need to know that I have a nice big profit zone, or at least the minimum profit zone that I'm looking for according to my trading or investing plan. Right? So let's talk about profit zone. So from selling short at supply, what I need to know is where is demand? Where is demand below this supply level? That will define my profit zone, right? And that'll help me understand what is my risk compared to my reward. Should I take the trade? So when price is coming back up here, and when price is back up at the level, I already know where, looking at this picture, I don't know where demand is below current price because we don't have enough data on the chart that I showed you here, but I certainly know where it's not, and that's important. Follow me here. The fact that price came all the way down to here prior to coming back up to here tells me for a fact that you can't have any significant demand above this price. The significant demand is either this price or lower. And if it's lower, we just have to look, down and left and find the demand zone. But the fact that price goes from here to here and then to here tells me for a fact that you can't have any significant demand above this price. Does everybody understand why? This is very important. Because what that does is it then tells me that I have a very quick and clear profit zone, at least down to here. In other words, the fact that price, if there was a significant amount of demand above this price, would price ever get down to this level? No, it couldn't. It's impossible. If the floor is that strong, are you ever going to fall through it? Right? In fact, when price is down here, can there even be one unfilled buy order above this price? Right? No. Okay. So then, again, let's keep this real basic. When price comes back up here, especially if you're new to this, and this is something most people don't do, getting ready to sell short. I know according to the rules, I'm supposed to sell short, but if you're new at this, you always want to ask yourself this question. Who are you selling to? And if you're buying at demand, who are you buying from? Okay. Now, I don't know exactly who I'm selling to here or who I sold to. I don't know their name or their address or how old they are, but I certainly know if they're a profitable buyer and seller, and that's the information I need. That's what I care about. How do I know that? Well, let's focus on the actions of the buyer, the person who's buying from us. Here they're making two key mistakes. Mistake number one they're making is they're buying after a big rally in price. Would you ever do that in any other part of life and be successful consistently with that? Do you ever buy, do you ever walk in the car dealership and say, look, I know that car is only $20,000, but I like it so much I want to pay you $40,000 for it. Has anyone ever done that? Right? No matter how much we like the ice cream at the grocery store, when you go to check out, you ever tell the cashier, look, I know it's only $2, but this ice cream's so good, I want to pay you $6 for it. Please take it. You ever do that? Of course not. We would never do that in any other part of our life. So why is that what people do here with their hard-earned money? There's a reason. Mistake number two is even worse. Okay. Mistake number two, the buyer who is buying here is not only buying after a rally in price, they're buying into a price level where the chart already told us banks are selling, almost guaranteeing a loss. Now again, I started my career on the bank side of the business, on the trading floor. So I'd be working a giant sell order, for example, at a specific price, and then all of a sudden price would get back there and the retail phone line would start ringing. And I'd answer it and they'd be like, buy 5 at the market. I'd be like, okay, stop screaming at me. They're so aggressively buying, and I'm thinking to myself, wow, they're buying 5 at the market here. I've got like 5,000 to sell. This there's no chance that this person's going to make money. Make sense? All I did was take all that and put it on a price chart. Period. Okay. Now, another word for supply is wholesale. Retail. Okay. Now we're talking about this is the S&P here, but if we were talking about the market for jelly beans or toilet paper or toothpaste, it's the same conversation, right? It's all just wholesale retail. Okay, so we sell short here with a protective buy stop above the level to manage the risk. Okay, we have to be really good at managing losses. Small losses, much bigger profits. And then price comes down to the blue line, which is our profit target. Now notice, you see all the candles and all the time it took for price to move from the supply zone down to this point right here? See that? I don't know, what do you have? 1, 2, 3, 4, 5, 6, 7, 8, 9 candles. It takes for price to get down here. When we get in and sell short, notice the amount of time it takes to get back down to that level is less than half. You're almost always going to see that. Right? Now, does everybody understand why? As price is coming down here, those buy orders at these price points are being filled so that when we get in, there's not much, if anything, to stop price from falling much quicker. It's like the snowplow effect. Let the snowplow go down the side street first, and then you drive down it. It's the same thing. Does that make sense? No, Jerry, I would not add volume into this. Okay? No need to look at volume or think about volume. All right. Let's keep going. So this is from yesterday and today. So the screenshot, both these screenshots were taken early this morning. So there's my name right there. I deliver live trading sessions each morning, pretty early in the morning. And this is one from where we set up at a level yesterday, and it met entry yesterday, and then it's still falling to our target. We had a really big target on this one because demand was much lower. But let's walk through it. And again, I want to stick to this. Let's stick to those two questions. Where is price going to turn and why? Where is price going to move to and why? And it comes down to focusing on where are the filled orders? That's where prices turn. I'm sorry, where are the unfilled orders? That's where prices turn. And where are the filled orders? Those are the price levels. Filled orders facilitate price movement, right? It's all about looking at a price chart and finding those footprints. Filled orders, unfilled orders. Got it? So here's a live trading session I was delivering yesterday. Price was trading in here. This is the S&P. Okay. And we had two fresh supply zones sitting on top of each other at that point. There's a bigger screenshot of them over here. But again, notice, very little trading at the levels. Oh, I'm sorry, this is the NASDAQ. We'll look at the S&P next. This is the NASDAQ. We had it in both. Okay. So very little trading at both of these levels, and price collapses out of the areas. So we had our pattern that represented big supply, a big supply-demand imbalance on the supply side. Strong move out of the area, very little trading, again telling us there's a big supply-demand imbalance there. But we hadn't had the Fed news yet, right? So then, of course, you know, the Fed news comes out, price shoots right up to our level, and actually meets entry by 1 point. So that was a close one, and then collapses. Now, price still hasn't hit our profit target. That's why it's still going. As you can look over here, demand is much, much lower, but we'll talk about that in a minute. But I really want to focus in on something very, very important. Back to the main topic of this webinar. Okay. When price met entry right here, when it came up to our supply zone, let's look at the information we had. First of all, on the where is price going to turn side, here is the picture of many unfilled sell orders, supply, or retail prices. Okay. Now so prices are going to likely to turn there, right? But we have to answer the second question too, otherwise we have no trade. We need to make sure that prices are very likely to move lower, move lower. And for that, we have to make sure that we don't have any demand anywhere close. So do we have evidence of that? Take a look. This area here that I'm circling, which is right here on the chart, okay, this area right here, you tell me, is this the picture of filled orders or unfilled orders? All this wide and whippy, tons of trading activity in here, is that the picture of filled orders or unfilled orders? Yeah, filled orders. You can buy and sell as much as you want in there, right? Okay. So, filled orders here, unfilled orders up here, price rallies up, turns like it's supposed to, and look at how fast it goes right through all this. Do you now understand why that happened? Because there was nothing to stop it. All of this trading activity in here cleared out any buy orders that were sitting there, so that after we get in, price can move very quickly through that level. And then, of course, if we want to know where it's likely to go after this, we just look left and down, and here we see that, again, we don't have there's no picture of fresh demand in here. There's nothing in here that even comes close to qualifying as demand, so that's why we had such a big target on this trade. Okay. All right. By the way, is there anyone that's with us here today that's in these morning sessions with me? Anyone in here with us? All right. All right. How you doing? Good to see you. Good to see you guys. And Mary, hi there. Oh, okay. All right. So I'm all right. Well, so the group that's saying yes, I mean, you folks can answer any of these questions as good as I can. Now, here's why. So, one of my fears is that this people see this and hear this, and obviously we're showing you very real stuff here. This is all screenshots of live sessions. But my fear is that it looks too easy. Does it seem too simple to anybody? Right? You know the old saying, right? If it seems too good to be true, it is too good to be true, right? Yeah. It's okay if because I'm sure it does. Here's the catch. You ready for the catch? And I don't want to burst anybody's bubble here, but there is a catch. Okay. While the rules and logic are very real and very simple, the act of doing it is not easy. Okay. It's right. This is just all I'm giving you here. I'm just the messenger. I'm just saying here's how markets really work. Right? This is not it's not any fancy algorithms or crystal balls or anything. This is how the markets really work. But here's the catch. While the rules and logic are very simple and very real, active doing it is not easy. And this is a great example. Yesterday, big news comes out. The NASDAQ, S&P, Dow, all of them, they shoot up like a rocket. Okay? So, how comfortable are you going to be pushing the sell button up here or putting in an order to sell when one of the biggest, heaviest volume markets in the world is, skyrocketing right off a big economic report? Is it going to be a little uncomfortable? All right, good point, Connor. Good point. Right? So, okay. So, I really push people to just, follow the rules, set and forget your orders. TradeStation and the platform technology these days makes it very easy to do that. Entry, stop, target, put the order in, go live your life. Either one of three things is going to happen. Either the trade's not going to meet entry, you're going to lose a little bit of money, or you're going to make a lot more than you are risking on the loss side. And as long as you're good with all three of those, there's no reason why you need to sit here and watch it. Life is too short for that, in my opinion. All right, let's move on. The main point I wanted to make on this was starting to clearly identify the difference between unfilled orders and filled orders. Prices turn at unfilled orders, and filled orders facilitate price movement. Let me ask you this. Here's a big question. What if we didn't know? What if you didn't know that there was Fed news coming out yesterday, and what the news was, what the outcome was? What if you didn't know any of that stuff? Would it have changed anything? Did it even matter? Exactly, Kyle. Okay. Here's a deeper question. Knowing that news and focusing on that news, does it actually help you? Might it hurt you? See what I'm saying? Okay. Yeah, as far as news goes, I mean, news typically just speeds up what was going to happen anyway with price, right? Okay. And my point with the whole, with what I just said was, if news comes out that is positive, and I'm not saying, news is wrong or misleading or anything like that. Look, when there's good news, there's good news. And most people buy when there's good news, and prices shoot up like they did yesterday. Okay? But the conversation around whether news is good for a company or an economy or whatever else or bad, and how you make money buying and selling that stock or market is a completely separate conversation. The reason why, remember I started with one of the most important things in the beginning was, my fascination in the beginning of all this years ago with how are banks and financial institutions, how do they make so much money and everyone else doesn't? I was fascinated with that, and I was determined to figure that out. And early on in my young 20s, I'm like, you know what, I'm gonna figure this out, and it's gonna be like some big secret, some fancy algorithm, and I'm gonna figure out what some Ivy League, economist or trader that's a lot smarter than me knows, and I had all these thoughts. Guess what? I figured it out, and I was and it's not that big of a deal. Ready for the big news? Ready for the big reason why financial institutions make so much money and everyone else doesn't? You ready? It's because here's the Holy Grail. It's so simple. It's because the smart money, right? Banks, financial institutions, people who do well at this, they understand that how you make money buying and selling anything in life is exactly how you make money buying and selling here. There is literally no difference. You look at Costco, Walmart, any of those big retailers, Sam's Club, any of those, Amazon, any of those. How do they make money? They buy it wholesale, sell it retail. What about Goldman Sachs, JP Morgan, Bank of America, any of those, Morgan Stanley? How do they make money? How do those groups make money? Let me ask you this. What's the big difference between Goldman Sachs and Walmart? What is the difference? Someone tell me. What's the big difference between those two companies? Is there a difference? Right? They're both in the same business. They buy it wholesale and sell it retail. One is buying and selling, toothpaste and gym shoes and toilet paper and stuff like that. The other one is buying and selling stocks and bonds. Make sense? Okay. All right. Let's keep going. Not going to spend much time here. This is the exact same trade, only we took it in the this is in the S&P. Okay. So this is yesterday into today. We had two supply zones sitting on top of each other. All of this trading activity in the middle here. All these orders being filled. News comes out, price shoots up to supply. Right? Whoever was buying from our group. By the way, with our group here today, that are in the morning sessions with me, how many of you took these trades in the Nasdaq and S&P? Anybody with us here today that is in my sessions that took those trades? Because and the reason why I ask is, they're in it. They, it's that feeling of, setting the emotions aside and sticking to the rules. Okay. All right. Good job. Well done. All right. Okay. So same trade, same everything. So let's move on to the next. Let's get past this one. Everybody, I think a lot of you probably remember what happened on February 5th. The big market plunge, biggest one-day point decline in market history. We also had that in the morning session. And but let's move on past that. I want to spend a little time on this one. Here's another one. Okay, and we've got some buys in here too. Let's get through this and we'll get to some buys. But real quickly here again, I just want to point out another live trading session. Here's our supply zone. Price is trading sideways, very little trading, strong drop in price. And then again, notice all this trading activity. So this represents supply or retail prices, meaning there are lots of unfilled sell orders. Right here where I'm pointing, that's where the last buyer bought and there was a significant amount of supply left over, prices fall. So this is where we expect prices to turn here. We sell short. But now let's look at all this. Again, what does this picture represent here? Filled orders or unfilled orders? Yeah, filled orders. All this wide and whippy price, trading action, and the amount of trading activity here, right, tells us clearly most, if not all, orders in here are filled, which is why price goes up here so quickly and then just comes right down. That's why we put our profit target down here. Okay. Unfilled orders, filled orders. Prices turn, prices move. Again, sticking to the rules, we sell short right here at our proximal supply line. The red line above is where we protect our protection, our risk, right? If price comes up to here, our buy stop order is triggered. We take a small loss if we're wrong, and if we're right, prices come down and hit our profit target. The way to get the emotions out of this, okay, set and forget your orders. Don't try to be a superhero. Our brains are not wired to do this correctly. Okay. And again, if you're new to this, ask yourself up here, who is the buyer? Okay, who's buying up here? Just like these examples. Let's go back a minute, because these are probably more extreme. Here in the S&P, yes, somebody bought up here, and you can see there's people in our group here today that were with me that actually sold up there. Right? I think Mike, you were one of them. Whoever you sold to, what was that? That buyer was making those two mistakes: buying after rallying price into a price level where banks were aggressively selling, and the buyer obviously didn't know that the demand was much lower. The buyer simply thought that this market was worth buying right here. Okay, Michael, you should send him a thank you note. No, I'm just kidding. Look, I'm not happy. I'm not comfortable. We talk about who's on the other side of your trade, but it's not. It's really my heart's not comfortable talking about that because you don't want to see anybody lose money. But I didn't design these markets. This is how they work. So I want to be as brutally honest with you as possible, because I don't want you to be the buyer up at supply, and I don't want you to be the seller down at demand. Okay? Yeah. So I see some people asking about indicators. We absolutely stay away from indicators. Would never use an indicator. Let me explain why. You've got your moving average, all your indicators and oscillators. They're all a derivative of price, right? In other words, they're just going to do what price has already done. And so by adding anything to our decision-making process that lags price, all we're doing by definition is increasing risk and decreasing reward, which we would never want to do. But let me ask you a specific question. If we were using, for example, I don't know, people use two moving average cross sometimes as an entry signal, right? So for this entry right here, let's say you're waiting for moving averages to cross to sell short. What would happen here? What would happen or not happen up here at supply? Are the moving averages going to cross right here at the supply zone when the risk is low and reward is high? No, never. In fact, for a fact, they're not going to cross there. Prices aren't going to cross lower until price starts falling. Okay? All the chart patterns, indicators, oscillators, the reason why you don't see people making a consistent low-risk living with those things is because they all force you to buy after a period of buying and sell after a period of selling. And there's no way to make money doing that consistently. You'll be right once in a while, but over time, it can't work. It's completely opposite of the basic laws of supply and demand. All right? Well, let's keep going. So this is not just about day trading. And again, some of the markets, we'll look at some Forex markets, stocks, futures, Forex, options, real estate, anything. Okay, anything we can chart, mutual funds, you name it. All right, So here's a trade that I just got out of a little over a week ago, and this was in options, and this is not a little day trade. So here's a daily chart again of the S&P, the major stock market. So again, just back in, so this is options, right? Back in late October, we had a demand zone established. When prices came back to that demand zone, I just bought calls. Okay, September 2018 calls. All right, here's the cost basis for those calls right here. Okay, so instead of having my capital or principal in the market and taking on all that risk, I actually keep most of that in bonds. Okay, try to follow me here. Short maturity, high yield, very safe. With those interest payments on the bonds, I use that free money to buy calls on the market. Okay, so then the market went up, market came down, and when it came down, it established a supply zone up here on a daily chart on the biggest equity index market in the world. So just last week or late the week before, prices got fairly close to that supply zone, so I exited the calls. Okay, they more than doubled in price. Made a nice profit on it. But remember, so think about it. I was able to capture stock market gains without any stock market risk to my principal, because the investment capital is in bonds. It's not actually in the stock market. Does that make sense? And again, what I'm talking about right here in like 2 minutes is a whole lesson that we don't have time to go over here. No, buying calls, not naked calls, not selling. Again, most people, the average person, has their money sitting in the stock market taking on all that risk. You don't have to do that. It's a whole nother way of doing it. Again, it's another thing that, working on the Wall Street side of the business for a little while, I saw firsthand how a Wall Street firm invests their own money and manages their own money. And it's very different from what the average person does. Okay, but again, just applying the basic supply-demand concept, that's how we make our decisions to trade options. Okay, yeah. So the chart is the S&P, and I took the position in the Qs. Okay, the Nasdaq chart looks very similar. There's now a supply zone here as well. Okay, Ross, bonds, bond funds. There's 2 bond funds, and then real quality corporates. Okay, and with those interest payments, use that free money to buy calls on the market. So again, it allows you to take advantage of stock market gains without the stock market risk. All right. So let's keep going. And again, so that was a multi-month position. Again, I want to give you a little variety here. This is not just about day trading, right? Here's a trade that we took in our sessions in corn. This one lasted about 3.5 weeks. Anyone with us here today in the sessions take this corn trade? I'm sure you guys remember this one. But I want to focus on our concepts, right? Fresh levels, big profit zones. So no, Mark, I wanted to wait until we develop some supply. Okay. But certainly when there is supply, but Mark, the next time a position is put on, once the market does come down to demand, we now have those supply zones above, so we can do it that way. Now we can set an entry price and an exit price. Make sense? Okay. All right. But Louis, the way you would know it's oversold is if it's fallen far from supply and nearing demand. Okay. Now, you asked that, so a lot of times people that ask a question like that are thinking overbought and oversold indicators and oscillators, right? Here's why that doesn't work. If a market is, let's say, today's a great example. Prices are falling from the supply zone we established, right, yesterday, and they just keep falling and falling and falling because demand is much lower. But what are the overbought, oversold oscillators doing all day? They're oversold all day, so people that make buy and sell decisions on them are getting killed because they're thinking, oh, the oscillator's oversold, I should buy. Well, that thing's going to stay oversold until you get to demand. Make sense? And again, I don't want to be too direct or yell at you or anything. I've just got an hour with you here today, so I want to be as direct as possible and, and make your own decisions. Okay. Yeah, that's true, Bill. All right, so on this one, again, these are larger time frame charts of corn futures. We were watching this, and we saw that two demand zones developed on top of each other, creating, instead of one stack of buy orders, we had two stacks of buy orders on top of each other. Okay. At the same time, we saw that supply was much higher. This doesn't look like much of a move, but remember, this is a daily chart. This is a massive move in corn. Okay, here's your risk over here on the right. Here's your reward. But I want to point something out. So over that time, prices came back to the demand zone, and the reason we bought here, remember, is not just because there was demand. Okay, it was a great demand zone. It scored out very high with our odds enhancer scoring system. But unless there's a significant profit zone, we don't take the trade. And when we look to the left and we see all this, none of this is supply. None of it. This all represents, filled orders. This is not supply. Supply was up here. I'm sorry, up here. Okay. So price came down to our demand zone, quickly moved up to supply, to our target. Why? Because there was nothing to stop it. The snowplow had been through that area and removed the sell orders for us. Make sense? Okay, let's keep going. Yeah, let's keep going. I think we looked at enough of these. Here's copper. Again, real quickly here. Again, here's the entry point for us, one of our sessions. Okay. Here's our two supply zones. Price collapses from those areas, suggesting a big supply-demand imbalance here. But again, here's the picture. It represents supply or unfilled orders. Banks are selling up here. And now, the fact that price comes down to here before going up to here where we sell short and bet on the downside move, okay, the fact that price comes from here to here means that all of the significant buy orders are filled down to here. Okay. It's a very important part of our piece here today together. And again, like I said before, notice all of the candles and all the time it took to get down to here. Okay. It takes that amount of time because as price falls, price is met with buy orders. So those buy orders have to be filled and more filled and more filled and more filled. But price gets down to here. Now, notice when price gets up to our supply zone, look at how fast it falls to our target. Why? Okay. Because there's nothing to stop this from happening because of that. All these sellers here did a lot of the work for us by removing the buy orders so that when we get in, price can move much quicker. Like I said before, typically this move after you're in is going to happen in half the time or less than this. Okay. All right. Exactly. So this again is another one from just the you could see a little bit earlier in the month. And again, this was not a little day trade. This one took about a week. Here we were buying the S&P. Here's our little demand zone, and here's where a bunch of our members bought. You could see the profits they reported inside the chat here. And but again, when price came down to this level, all of this had already happened. Pay close attention here. All of this had happened between the time that a demand was established and our entry point on the buy side here. Okay? So again, my question, what does this picture represent? Filled orders or unfilled orders? Look at all this activity. And look at all this wide and whippy activity. Yeah, it represents filled orders. Okay? Therefore, we expect prices to turn where the unfilled orders are on the buy side and move through the price points where the orders are filled. This is simple motion into mass. Someone told me Isaac Newton was not good with his money, but I bet he would have been a good trader because he had all this figured out back then. Make sense? Mass is just the unfilled orders. Now, again, like I said, this is, while the logic and rules are very real and very simple, the act of doing it will challenge you. And here's a great question. Right here, when the biggest equity index market in the world is basically, collapsing, are you going to feel comfortable pushing the buy button here? Right? A lot of people won't. Which is really crazy to me, because think about it. What if I told you, you know what, this is not the S&P. Instead, this is that really cool 80-inch Samsung smart TV, the curved one. And instead of where it's normally $8,000 to $10,000, right here, it's on sale for $1,000. What are you going to do? And there's only 2 left, by the way, and they're right down the street. What are you going to do? Yeah, of course you're going to buy it. You're going to sit here and listen to me? You're probably going to drop your headset and go run, right, and buy them. Of course. And yeah, right? But because it's a financial market, everybody starts to think different. Again, this is why Wall Street makes so much money and everybody else doesn't. I see someone wrote up in the chat, contrarian. This is contrarian. And again, I'm not picking on you, but I've heard that before. People say, Sam, this is great, and all this stuff, and it's contrarian, but that's okay. Is it contrarian? Is it really contrarian? Is the thought of buying low and selling high, buying at wholesale, selling at retail, contrarian? And again, I'm not picking on you. I've heard that thousands of times. And every time I hear it, I think, that's why it works. People think it's contrarian. It's not contrarian at all. We are conditioned from a young age, and all through our years in school, to think backwards when it comes to buying and selling in the markets, investing for our future, right? Buying and selling when it comes to our retirement savings. Everybody's conditioned to think backwards. Everyone's saying, don't buy when prices are down. Only buy when the news is good. Make sense? How do you think Wall Street feels about everybody being afraid to buy down here? They love it. I was on that side of the business. Here's another reason why a lot of people will get this wrong. What is it when we buy here, right? When our group in this room was buying here, what was the trend in price? What was the trend? Up or down? Right. What are you supposed to? Yeah, it was down. What are you supposed to do in a downtrend? Buy or sell? Come on, it's written in every trading book ever written. Right? Yeah, you're supposed to sell. Okay. It's like forbidden to think to buy in a downtrend. You see my point? Okay. Everybody's conditioned and trained to do this backwards, do this wrong. That's why there's such a gap in performance between those who do this right and those who do this wrong. As I kind of say at the bottom here, I learned this long ago. Trading is simply a transfer of accounts from those who don't know what they're doing into the accounts of those who do. It's just how it all works. Anyway, I hope our session today was helpful. There's my email address if you have any questions, sseiden@tradingacademy.com. Always make sure you understand the risk with any buying and selling in the markets, short-term trading, longer-term investing. Make sure you understand how to lose properly. And it's great being with you. And we'll see you